Hi everyone. So today we're going to be looking at the four types of financial statements. So the first one is the statement of profit and loss. What is this? Well, it shows you how much profit the business is making or how much losses the business is making over a given period of time. So normally businesses use a year to report their results. So profit is a good figure in the sense that it shows you how efficient the business is. But the problem with the statement of profit and loss is that it's not showing actual cash flows. It's not actually showing how much net money you're making as a result of your operations. And that's because the statement of profit and loss is generally prepared on the accruals basis, which we've discussed in previous presentations. The next one is the statement of financial position, and it's also called a balance sheet. Now, it's like a photograph of the business at a given point in time. It's a snapshot. And it's telling you your assets, liabilities, and equity. And it's called a balance sheet as well because your assets have to balance with your liabilities and equity. It's a good statement to have because it shows you how the business has been funded and whether there are liquidity or potential going concern issues, i.e. whether the business is sustainable in the long term. Liquidity is to do with short-term funding, having enough cash to meet the short-term needs of the business. We then have statement of changes in equity. Now the statement is obvious, it's just showing you the movements in equity. So it's showing you it will show you the capital injections into the entity, any dividends paid out. What you also see is the profit and loss figure that came from the statement of profit and loss. Okay, so it's reconciling the opening equity balance for the period to the closing equity balance for the period. We then have statement of cash flows, which is showing you all the cash flows during the year. The difference between the other three is that the cash flows is not prepared is actually showing you the actual cash flows in the business, where the business is losing money, where it's spending money, the most money, where it's gaining money as well. And it overcomes the issue of the statement of profit and loss figure, I think, because it will show you eventually the cash from operations. So you could be making a loss of, say, minus 100k, but from your operations you could actually be making money because, within that loss you have non-cash flow items like depreciation and amortization. Okay guys, that's it, but stay tuned for statement of profit and loss, which we'll go on to next. Thanks, bye.